Hi, everyone, and welcome to today's webinar. I'm Gina. I'm a investor relations associate here at Birgo, and today we're going to be discussing the Birgo Opportunistic Fund, and I'm going to hand it off to Mitch and Andrew.
Thanks, Gina.
Welcome, everyone. My name is Mitch Young. I'm the Vice President of IR here at Birgo. I oversee investor relations team at Birgo Capital. I'm actually relatively new to the real estate world, but bring a lot of high growth experience in the tech sector with a bunch of different successful exits and specialize in go-to-market strategies with companies just like Birgo who are looking to scale. And I'm actually joined here today by Andrew Reichert, the founder and CEO at Birgo Capital.
Hi, everyone. Thanks for joining.
Andrew continues to cast the strategic direction of Birgo Capital and drive execution of our work across the entire team. Prior to founding Birgo, Andrew led investments, developments, and operations at major institutions. Today is going to be pretty simple. We want to go over kind of what it means to build passive wealth by investing in multifamily real estate, how Birgo Capital goes about doing that, and specifically look into the Birgo Opportunistic Fund to give an overview of how we accomplish this. To do that, we also want to go through a track record with Andrew, since he was the founder of Birgo, to kind of walk us through what we have accomplished historically, and then we'll end with a very simple Q&A. You see, as we reflect, we believe that building wealth can be done best through multifamily real estate. Multifamily real estate provides cash flow for you to live off of, retire from, and also has significant tax advantages. In addition, the fundamentals of workforce housing, which Birgo specializes in, are in demand. There's a more pressing need for high-quality renters, with many postponing or skipping the pursuit of home ownership. These changes and preferences continue to drive forward our work to provide quality apartment communities, change the lives of our tenants, and ultimately improve lives through real estate. Through our work, we're also able to improve the wealth building of our investors. And this is why we recommend adding multifamily real estate with a successful operator with an impact-driven team and track record to benefit your portfolio. There are multiple benefits to investing in multifamily real estate. First is diversification. Instead of investing in a single-family home where you only have one tenant, and you can invest in a multifamily property with 100 units that have 100 different rent checks. And if 10 tenants leave, you still have a 10% vacancy instead of 100% vacancy in a single family home. It also provides passive income. When you invest in passive multifamily funds or deals, you're leaving the headaches to us, and we do all the work to operate, manage, and improve real estate, so you get to see the cash flow and distribution checks in your bank account without having to lift the hammer. It also brings stability. With market volatility and fears of recession, downturn, or even a major event, multifamily continues to have significant demand and be a necessity for individuals and families to live. Because of that demand, multifamily has been far less volatile than the stock market. See, in addition, there's also tax benefits. One of the largest expenses that you will ever have each year, and honestly for the rest of your life, it's taxes. By investing in multifamily real estate, you receive significant tax advantages by receiving pass-through depreciation, deductions, the ability to defer capital gains tax, and much, much more. At the end of the day, our investment strategy is to invest, improve, and manage workforce housing in the heartland of America. The heartland and our current focus is Western Pennsylvania, with a focus on Pittsburgh and the surrounding areas like Western New York, Ohio, and West Virginia. We believe at our core that multifamily assets in the heartland represent an opportunity to achieve superior returns while incurring risk well below that of investments in the traditional coastal markets.
So now that we've talked a little bit about the benefits of investing in multifamily real estate to build passive income, let's talk a little bit about the history of Birgo Capital and what we think makes us unique. So Birgo Capital has existed for over a decade, and its predecessor firm, Go Realty, was established back in 2012 to be a boutique real estate operating. In 2013, the actual asset management side was founded through a sister fund called Birchmere Advisors. In 2015, we fused those together to create Birgo Capital and launched our first. We raised $17 million with a target of $10 million. And after we deployed that capital in 2018, we launched our second fund and raised $45 million, which we deployed into about 800. 2020, we really started to grow and fuse Go Realty's operations and Birgo Capital's asset management into a vertically integrated real estate operating company that exists today. And this year, 2023, we launched the Birgo Opportunistic, which we'll talk a little bit. Team Birgo now exists of over 90 employees that oversee all aspects of stewarding your capital. That's real estate operations, from property management to fund administration and finance, and really everything to keep the properties working as they're. And in addition to this, we have relationships with tenants, vendors, and all parties involved to keep everything functioning as needed. And over the past decade, we've assembled over 300 million of assets under over 3,000 units, and we've generated a gross internal rate of return of over 19. We're super proud of that track record. We think it's a real differentiator for us. And that is what caused us to launch the Birgo Opportunistic Fund, which you'll learn about today.
Ultimately, we are so excited about the Birgo Opportunistic Fund because it does represent a unique offering here at Birgo. The Birgo Opportunistic Fund is a private real estate investment fund that seeks to take advantage of temporary price dislocation in the multifamily real estate market. The fund seeks to identify and acquire properties that need to be sold due to distress from rapid shifts in the macroeconomic climate. The objective of the fund is to achieve an annualized net return of 16 to 20% to our investors. See, the present real estate market contains a lot of assets with the following characteristics, which combine to provide a unique and temporary acquisition window. One, loans approaching maturity, which cannot be refinanced at current leverage ratios. Two, over-leveraged properties with negative cash flow due to floating interest rates. And finally, assets with rents that are deeply below market due to abnormal recent pace of inflation. And this fund seeks to achieve its return objective by acquiring these properties at a discounted cost basis, capitalizing them with uniquely advantageous capital structures, and then executing on value-add business plans.
So what makes this particular investment? Well, there's really three ways that we think that this opportunity is unique in the market. One, it's actually outsized value creation. So that's creating a disproportionate appreciation through forcing that appreciation in a value add strategy. Second is downside protection. Because we're acquiring these at a discount, there's already immediate value creation at the acquisition, which provides downside against potentially shifting markets in the future. And third, rapid uncorrelated return. What this means is that the returns in this real estate are rapid and uncorrelated to the larger market. So while the larger market may be going through ups and downs right now, real estate is sort of slow and steady up and to the right. And because of that, we're expecting a 2x multiple. Additionally, this fund is a little bit unique in that it's actually a bit of a GP fund where investors have the opportunity to co-invest directly alongside individual assets. So that means you as an investor will get an entire portfolio of assets, but you'll also get first look at any syndication of the individual assets within the and that allows you to participate in the upside, or sort of the GP economics, for the entire fund. And mentioned earlier, Mitch had mentioned this, it's a highly tax efficient vehicle just because of the way that the fund is structured and the way that depreciation of those individual assets is going to be pushed up to the parent fund. It forces a lot of depreciation through the fund, which we think is going to provide great tax benefits.
Some key facts about this fund. So what is our target IRR? It's 16 to 20% with an equity multiple of about 2x. There is a preferred return of 8%. And the frequency of distribution is actually none initially. We're going to be investing a lot into these properties to get them to perform the way we know they can perform, which means you'll expect your initial distributions 18 to 24 months post initial investment. Once again, the location is the heartland. It's Western Pennsylvania, Ohio, Western Virginia, and West New York. The property types are all pretty much one thing. It is workforce, family, multifamily housing. It is a 5-year fund, which commenced in March 2023. The sponsor co-investment is $500,000, and the LP-GP waterfall split is 80% LP to 20% GP. A couple of examples of assets that we have already moved forward with in the Opportunistic Fund to help you see some of our strategy. We identified a property in Buffalo, New York that had 191 units. It was owned by an aging generational owner and the original developer. I think the phrase here was that his property was in Buffalo, but his heart was in Florida, and he just wanted to get out of this property. It was also, resultantly, severely underutilized. The average in-place rent was $501, but in a market that demonstrated rents between $795 and $975 through just moderate unit upgrades. The deal level IRR on this specific asset was in excess of 22% upon our initial underwriting. Another great example was this asset in Cleveland, Ohio, that had 143 units. It was once again a retiring mom and pop owner that were disposing of some mismanaged general asset. It was a value add opportunity through renovations and increased rents. The existing rent roll was 29% below competitive set post renovation. It was right next to two big medical facilities, the Cleveland Clinic and Case Western University. And also it was near one of the most in-demand educational areas for both primary school and secondary school, with mostly just Class A assets available. So for anyone who can't afford Class A, this is really the only option. So with moderate to little increase and investment, we could really bring those rents up to where they needed to be.
So a little bit about governance for this fund. We take governance seriously. We want to make sure that we're kind of dotting our I's and crossing our T's. So a few things that we do. One, we have legal counsel in the way of Clark Hill that is reviewing all of our legal docs, all of our agreements of sale when we go out to purchase real estate. We actually get a review by a CPA for this fund. So we have a particular CPA that prepares all of our tax returns and financials. And then we have a separate third-party CPA that does a financial review of those. That's Cohen and Company. And then we actually have a limited partner or investor advisory board that provides strategic oversight. So they're advising us consistently, making sure that they're keeping an eye out for the best of our investment. And a little bit about our track record. So first of all, we've launched multiple funds, as we've talked about, that are actually pretty well aged at this point. So some of our funds are getting to 7, 8 years old at this point, and they've generated gross internal rate of return, as I've mentioned, in the high double digits. So 20% is pretty common. It's our funds generating multiples of 2x, 2.5x across various funds and even some syndications. A few specific examples of how we generate value and how we've done this with past properties. We bought 174 units in the area of Morgantown, West Virginia. We purchased it for right around $11.5 million. And just a year and a half later, it appraised for $13.2 million, generating a 44% internal. The real driver of that value creation was rent growth in this. Similar to those examples where we've talked about with the opportunistic fund, we bought with rents that were artificially suppressed and just brought those rents back up. Another example was 54 units in an area called Wilmerding called the Parkside Apartment. This was purchased for just $2.2 million and we refinanced it for $3 million just about 4 years later, generating a 24% internal. Now, the real driver for value creation here was actually cap rate compression. As cap rates have fluctuated, this was an opportunity where we bought a property at a higher cap rate and sold it. And the third example is the Sylvan Ridge apartment. So this is in Beaver Falls, Pennsylvania. We purchased for $5.5 million, 120 units, and we refinanced it for $8 million just 3 years later, generating a 42.7% rate of return. Now, the real driver here was actually expense reduction. So one of the things we did is we went in, we looked at the existing property expenses. We were able to cut those expenses down and generate disproportionate value at that asset, increasing the net operating income, thereby. So as you can see, there's many ways that we generate value across the properties. Many of these are the same ways we intend to generate value in the opportunistic fund. And we're excited to have an opportunity to steward your capital through this opportunistic. So with that, would love to open it up for any questions that you might have.
Thanks, Andrew. We actually did get a couple of questions in. Someone did ask, can they invest through an LLC, an LP, or a trust?
Oh, yeah, that's a great question. Yeah, we often have investors invest through entities. So LLC, trust, partnership, whatever vehicle you have in place, or maybe you want to set up for this venture is totally fine. Obviously subject to owner and investor requirements, based on laws, the various entity requirements, but you can invest through it.
Wonderful. Mitch, in that same vein, someone wants to know if they can invest through their IRA or their 401k.
Another great question. And yes, 100%. So investors can invest as an individual through an IRA or a 401k.
And Andrew, another person asked, how are they going to be kept up to date on their investment?
Yeah, sure. So being kept up to date on your investment is pretty simple. We provide quarterly updates. So we have a investment management system called AppFolio Investment Manager that'll send you your quarterly updates, and you'll actually be able to go into that system and view your investment at any given time, where you can track the value of your investment over time. And of course, if you ever have any questions, you can always reach out to our investor relations team, folks like Gina. You can email at investor relations.
Wonderful. And then Mitch, someone asked about how their commitment will be called, upfront or over time.
Okay. So the capital call for the opportunistic fund is upfront, and you have a period of 10 days to provide those funds.
And last but not least, Andrew, well, not last, but someone did ask any additional tax benefits to investing in the fund.
Yeah. We talked a little bit about tax benefits earlier, but that's a great question, something folks are always interested in. So basically what we do is we do these things called cost segregation studies, where we segregate an asset down into its individual components. That allows us to accelerate depreciation. And as a partner, as an investor, you'll get a K1. And typically what will happen is we'll push that depreciation through to you on your K1, that will have your K1, kind of be zero or negative. It'll really wipe out your entire capital account is sort of our goal. So that allows you to earn those dividends, get those distributions that Mitch had talked about earlier, but really they would come, on a tax advantage. Now, obviously we're not accountant, we're not your CPA. So you want to talk to your CPA about your individual situation, but that's sort of how we can take advantage of tax benefit.
Excellent. And Mitch, now last, how can someone invest?
That is my favorite question. Well, ultimately, within the next couple of days, you're going to receive an email from the investor relations team here at Birgo. Feel free to respond back to any questions that you have, and someone from our team will reach out to you, whether it's myself or someone else. And you'll also notice a button where you can actually place a soft commit. This investment is done on a first come, first served basis, and it kind of lets us know how to pencil you in, at least prior to a phone call. And ultimately, let's hop on a call and discuss. Any questions you may have, we're here to answer.
Awesome. Well, we want to thank everybody for being here today. Have a great afternoon.
Thanks, everyone.
Thanks, everyone.